Well, good afternoon, everybody. Joe Lucey here with this week's Market Huddle. It's December 7th. Hi, Scott. How are you? I'm really excited because today we have Tim Sargent joining us. Tim Sargent is the institutional relationship manager with a money manager it's a newer money manager. We started using kind of introducing Sterling Capital to a few of our clients earlier in the year as part of our due diligence process. And now we're at a point that we're comfortable enough with them and excited to kind of introduce all of you a little bit more to Sterling. Tim, as I said, is the institutional relationship manager and what have you. So we'll go ahead and get started here. Let me get the slides up and running, and this is going to be an easy Market Huddle for me because I'll pretty much turn it over to Tim. But at the end of this, we'll have some time here to questions and answer. We'll take as much time as we need. I know Tim does have to be somewhere about 1:45, but we'll probably be done a little bit before that. And at the end, if you'd like to visit with us, we're down to 4 or 5, not even 4. Probably down to about 3 Wednesdays, three Mondays left of the year, maybe 4. So if there's anything that we want to be looking at with your portfolios between now and the end of the year, now is a great time. And if not, we can always schedule something for after the first of the year as well. So with that said, I'm going to go ahead and click myself off as well. Again, special guest this week, Tim Sargent. He is the client strategist. I call him the institutional client relationship manager over at Sterling Capital. And they've got a portfolio. They manage actually many different portfolios, but the one that we're most excited about is the Focus Equity Overview. Keep in mind, and many of you are already aware of this, I believe that if we're going to outperform an indice, it's a lot easier to do that with 25 to 35 individual stocks. We can have a fully diversified portfolio. I can outperform an indice with 25 or 35 stocks. It's really hard to do once we have 500. If I'm going to beat the S&P 500, the way to do that is to do that. Most of our clients, they hire us because number one, they're looking to maintain their lifestyle, to keep the income coming in, being able to spend in confidence. Number two, it's about tax planning. It's about how to reduce our tax footprint over time. And then the third thing where Sterling Capital really comes in is how do we increase our wealth without the compromise of those first two areas, the income and the tax planning that we do. So with that said, I'm excited to introduce Tim. In a few moments here, you will realize that Tim, they've got this new they talk about the COVID beard. You're going to see a good-looking picture of Tim here without a beard now that you've seen him with the beard. And at the end, we'll have a little poll on which you like better, with the beard or not the beard. I'm sorry, Tim. I'm just having fun. Anyways, here's our disclaimer. Anything we talk about, if it's tax planning, legal planning, anything like that, we're not attorneys. We're not CPAs, but we do help families manage their investments. We're certified financial planners, and Tim and his organization have become a nice little part of that. With that said, Tim, I'm going to turn it over to you, and I'll let you talk a little bit about who you guys are and what you guys do.
All right, Jay, thank you very much. Really appreciate you inviting me on to talk to your clients, and then thank you all very much, clients on the phone and on the webinar. Thank you very much for your time. I do understand you're very busy and I appreciate you joining us today. Thank you very much. Regarding the beard, Joe, we certainly appreciate the feedback, but trust me, the person who matters most, my wife, actually is the one who encouraged me to grow the beard. So I will certainly take what you say with a grain of salt, but the missus always wins.
Absolutely.
Exactly. So that's the background, a little bit about me, a little bit about the firm, and we'll get into the Focus Equity strategy. I'm Tim Sargent. I am the client strategist for Sterling Capital. I have been doing this for a long period of time. Shoot, for better or worse, this is the only industry that I have been in. I've been doing this since 1997. And then prior to that, I was actually an intern at a firm. So I've been doing this, I guess, since 1995, which takes me back to roughly my junior year in college. So certainly I have earned all the gray hairs on my beard and certainly the male pattern balding I have in the back of my head as well. I do have two beautiful young women. I've got a sophomore in college and a sophomore in high school. And certainly COVID has made that a little more challenging as well. Certainly, we have the academic pedigree. I have a double major in accounting and finance. Even though I live in the great state of North Carolina and have now for the past 16 years, I did grow up in the great state of Ohio, so I do have those Midwest roots, and I certainly do appreciate working with other Big Ten-like type geographical areas. There we go. Goodness gracious. So I guess I always say a picture adds 10 to 15 pounds. That's a little bit of a joke, but certainly that's a picture of me pre-COVID, and we will see what happens once we get the green light to get out and go and do things on a move forward basis. So let's talk a little bit about the firm. Let's talk about focus, and then we'll open it up to questions and answers. So who is Sterling Capital? I'm glad you asked, right? So Sterling Capital, we are a $70 billion institutional money manager that focuses on risk management. We are the largest money manager headquartered in the great state of North Carolina. When you're looking for asset managers, certainly you're looking for many different things. I would say one of them is you certainly want to have academic pedigree, and the other is you want to make sure you have experience. So we certainly have both. On the academic pedigree side, we have north of 50 CFAs, Central Chartered Financial Analysts, which is essentially the highest academic pedigree you can get, or certification you can get in my industry. It's a big deal. But to go along with that, you certainly need experience. I am sure that everyone on the call has met people who certainly can make it work in academia, but once you step outside of that, it becomes a little more of a challenge. So certainly we have the experience to back that up. Most of the folks that work with us have north of 2 decades experience in the industry, and certainly more than a decade with us here at Sterling Capital as well. So that's a little bit about who we are. The team that specifically manages the Focus Equity is led by Colin Descharme, and Jeremy Lopez is the associate. So it's always nice to have two people managing. And they are backed up by 5 then analysts as well. So it's a 7-person team. They all have their CFAs, Chartered Financial Analyst designations. Colin specifically, we always tease him, when is his career going to get on track? Because not only did he play professional basketball for a period of time, but also has his CFA, CPA, CFP, and then also has his master's in basically a rocket scientist. So he's one of those people that I'm sure if you put a piano in front of him, he can learn how to play the piano in just a few moments. He's that kind of talented. And then certainly Jeremy has been in the industry for a long period of time, has his CFA as well as his master's as well. So that's the team that essentially manages the portfolio. So then let's talk about what Focus is, what we do, kind of big picture, and then we'll drill down a little bit. As Joe mentioned before, we really believe in more high conviction type of portfolios, meaning we just don't want to have a watered down S&P type of portfolio. I'm sure everyone here on the call has heard the saying, or at least read, that the average mutual fund or the average money manager simply cannot outperform the index. And the answer is, yeah, sure. It's because of math, right? So there's something called active share, and I'll get into that in just a moment. But the way the math works, I thought Joe really did a nice job with this, is really once you get to that number he kind of talked about, that 25 to 35 type of number, you've really diversified kind of all the risk you can diversify out of a portfolio, as long as it is broadly diversified, right? You don't want to be a sector type of portfolio where you're all energy or all financials or all one or the other, right? But as long as you're broadly diversified, you've kind of done the best he can. And once you get to a certain number, it's really hard to outperform, right? If you have 300, 200 names in one of your portfolios, you trade very much like the index. And then if you put any kind of fee on top of it, it's almost impossible then to beat the benchmarks. So certainly when we hear that, yeah, it makes lots of sense that the average money manager can't. But that's certainly why you're working with Joe, and I believe Joe is working with us, is we are certainly not average, and we certainly strive to do much better, and we certainly have the same type of thinking with regard to high conviction and certainly that active share statistic. I kind of tease that active share. I'm going to get a little nerdy here, and I apologize for that, but just active share is what financial professionals like Joe go out, and it's one of the things they look at when they're looking at a portfolio to potentially add to their clients' overall investment solutions. And really, a bigger number is a better number. And if the lower number just means you trade much more like the index, whether it's the S&P 500 or whatever index you're looking towards, but a lower number is worse and a higher number is better. And certainly, we are definitely on the higher end of that scale. All right. So with that as the background, what do we do here at Focus? Well, with Focus Equity, we are a growth portfolio. Right? If you really think about two kind of major ways to manage money, you have kind of your growth and then you have your value. Certainly with growth, typically you're going to have a little more volatility. You're going to have a little more I guess we'll call it risk, for lack of a better word, when you're talking about that type of portfolio, simply because you're typically going to have a little more companies that have bigger earnings, more tech names, and so forth. So I'm going to talk about how we kind of mitigate some of that risk, and then really we're a great complement to what Joe is doing with the rest of your portfolios as well. So what are we doing here at Focus? What we're really trying to do is we are really trying to buy companies that we think are going to give us double-digit returns, right? We've all heard, hey, the market gives you whatever, 8, 9, 10, 12% a year. We're certainly trying to get that anywhere between that double-digit, and I've heard anywhere 12 to 15% on a year-to-year basis. Sometimes we can achieve that. Sometimes we have a little more challenges with it. But how do we do that, right? We really have three things we need to look at. First of all, you want to have a strong business. And you want to make sure that you have visible reinvestment opportunities, right? You don't want to have some sort of nebulous, hey, we think we can do better. You want to make sure you have visibility to it. Talented management, that really, truly matters to us. And I'm going to use a little bit of a football or a sports type of an analogy. And I apologize to you who are not necessarily sports fanatics like I am. But I'm going to take a look at two of the more popular college football teams right now. We might even take a look at a pro team, right? So Alabama, Clemson, those are two of what we call the stronger college football teams right now. However, they've not always been that way. I mean, Alabama feels like they've been that way for a long time, but prior to Nick Saban, the head coach, that talented management, that talented leadership being in charge, they were a dumpster fire. They actually lost to Utah in a bowl game the year before he got hired. And if you take a look at Clemson, which is very close to where I live, before Dabo Swinney, they called it Clemsoning. That was actually an adjective, right? So it basically meant that you lost a game that you had no business losing. Once you got the talented leadership, the talented management there, it really turned the programs around. And for those of you who are more pro-oriented, take a look at the New England Patriots, for example. Again, not the best long-term track record, but all of a sudden you get Belichick, you get Brady, and they were essentially unbeatable for 2 decades. So that's why we think it's really important to have that talented management. And then also we would like to take a deeper look. I'm going to go into this in a little more detail with our 4 pillars. We really think that we want to have a portfolio that has these 4 pillars, right? You want to have operating growth, strong balance sheet, high profitability, and attractive valuations. So what do I mean by that? Certainly, strong balance sheet, we call it a clean balance sheet. Essentially, what that means is we do not want to have a lot of debt or leverage on the balance sheet. And the reason for it is certainly leverage is great when things are good, but when you have challenges, i.e., let's take a look at 2020, right? Specifically first quarter and then through the summer. If you have a lot of debt or leverage on your balance sheet, and then all of a sudden you have some sort of credit crunch, or all of a sudden you have a liquidity issue, or all of a sudden shut down the economy, and you're going to have significantly less revenue or earnings, that debt or leverage is truly a double-edged sword and can really bite you. So we like to make sure that we have companies that don't have a ton of leverage. We want to make sure they have a lot of cash on hand. I heard someone say this once, but essentially a recession is a garage sale for rich. Right? So if you're a company that has a ton of cash on hand, you can take advantage of acquisitions. You can go in and buy up market share and so on and so forth when the economy is on a challenging time frame. So that's really why we look at the balance sheets. High profitability, that makes sense, right? Would you rather have a company that makes more money or less money? All right, that makes sense. And then certainly operating growth. You want to make sure that your return on equity is where it needs to be. And then evaluation. Certainly we are a growth type portfolio, which means we are going to have a little bit of a higher PE, like a price to earnings or some of the valuation metrics than some of the other managers that Joe is using in your portfolios. But we certainly want to make sure that we are keeping an eye on that, right? Because sometimes you have a great company, but you want to make sure you're buying it at the right price. So let's dig a little bit deeper into why we think those 4 pillars matter so much. And I know this is a little bit of a messy or dirty slide. For that, I apologize, but we're going to go through this and you're going to be wizards about it here in just a few moments. Again, you can basically take a look at the 4 different pillars you see up there. Which is, again, valuations, that's PE, price to earnings, robust operating profit growth, that's earnings per share growth, high profitability, return on equity, and then strong balance sheet, that interest coverage, right? You want to make sure that you're keeping a lot of cash on hand with regard to what's going on with your balance sheet. So I'm going to reference the top part right here, right? So you're just kind of, if you're looking at the top blue segment at the very top, what you can see is that when the market is in bull mode, meaning the market is going up, and this is, I think, a decent sample size. It goes from 1985 through 2020. What you'll see is all 4 of those types of metrics outperform the S&P when the market's going up, right? So that certainly helps us fish in the right pond. However, I did say that we are a risk manager, or at least I should have said we're a risk manager at the very beginning when I introduced who we are at Sterling Capital. And how we try to mitigate risk is taking a look at, again, those 4 different pillars. The bottom component, we'll call that the maroon or red. My wife will tease me because not only am I getting old, but my eyes are getting bad. But what that talks about is when the market is in bear mode, when the market is going down during that exact same time frame, that 1985 to 2020. And again, you can see all 4 of the pillars: return on equity, interest coverage, EPS growth, PE. They all outperform the broader market defined by the S&P when the market is also going down. So we think that using those 4 pillars, again, with the talented management and then also the reinvestment opportunities we talked about in the prior slide, they really allow us to fish in the right pond to get those right 25 or so stocks that Joe and I talked about to outperform the index, both in good and bad times. Excuse me for a second. Oh, my apologies for that. So how does that manifest itself out? So if you go back to the inception of the portfolio, and the portfolio is turning 5 years old at the end of the year, this year, you'll see that we have had success accomplishing what we're trying to accomplish. Right? We call this the upside downside capture ratio. Again, this is probably a statistic that no one's really talked with you about, so I'm going to get more nerdy, but nerds are going to nerd, right? So essentially what that says is when the market's going up on the blue there, on the up market, what percent of it do we capture? And then on the gold component on the right, you see the down market, what percent of when the market's going down do we capture? So essentially what that says is when the market's going up, we capture about 106% of it. And when the market's going down, we only capture about 89 or so percent of it. So let's just use 10% to make the math easy on someone like me. If the market's up 10%, historically, we're up 10.6. If the market's down 10%, historically, we're only down 8.9. So what that means is over longer periods of time, historically, that allows us to accomplish what we want with the overall portfolios with regard to superior returns while minimizing the overall volatility. So with that being the case, let's talk a little about the return numbers. If you're looking at the returns through the end of November, we've been pretty fortunate. For the month of November, Focus Equity was up north of 12% at 12.09. Year to date, Focus Equity is up 34.34%. And then since inception, and again, inception was December 31st of 15, we're averaging 24.5% on an annualized basis as well. And that's certainly a gross numbers that we're talking about there. But regardless of whether you're looking at different indices, the S&P, the Russell 3000, or the Russell 1000, the good news is we do compare favorably across the board. And again, depending on which index you're comparing us to, again, whether it's the S&P or the Russell 1000, we're either in the top 2% or top 5% of our category as well. So not only have we historically been able to do a little bit better when things are up and certainly lose less when things are down, but over the entire market cycle, we've been able to accomplish what better than 95 or 98% of our competitors have been able to do over the same time frame. So again, what we're trying to accomplish is really giving you those attractive risk-adjusted returns through any kind of market condition. Certainly 2020 has provided that for us. Certainly we hope this is not the norm on a move forward basis, and we certainly get back to the boring days of, we'll call it 2018, 2019, and so forth. Certainly we have a diligent portfolio management team. We want to make sure that we believe in active management. We believe in flexibility and going where you think the opportunity rises. And then certainly just a byproduct of what we do, we have relatively low turnover. And simply that means how often are we buying and selling stocks? We have relatively low turnover, which makes us, not by mandate, but just as a side note, more tax efficient than some of our brethren. And then certainly we are an institutional money manager that really leads us to have a long-term focus. And when I mean institutional money manager, I should have maybe mentioned this before. When you are talking about the client list we have, the clients that we work with would be Amazon, Adobe, the state of California, state of Florida, The Ohio State University, Facebook. Those types are our clients. So certainly those are firms that can hire anyone to manage their money. They've selected Sterling Capital, and the same intellectual capital that's working on those portfolios are certainly working on your portfolios and working with Joe and his team as well. So with that as the backdrop, I'm going to wrap up before we open it up or turn it back over to Joe by saying thank you so very much. I really appreciate your time, and I really look forward to, I guess, feedback on my marvelous beard, and then certainly like to answer any questions that you may have.
Yeah, it's too bad, Tim, that we didn't have a poll put together, because there's a way for us to do these polls, and we could have done like a little informal beard, no beard. But it sounds to me like your wife has already kind of laid down the law there, and you're probably going to be with the beard for a while. So that's good too. Anyways, you know what, Tim, we're going to get to your question in just a little bit, but I think hopefully everybody kind of gets an idea of why we have partnered with Sterling. I think that they do a great job. We obviously, through our due diligence process, we want to always make sure that we're working with Arlen is telling you to keep the beard there, Tim. Always make sure that we are looking at money managers that we believe can give us this wealth accumulation like we're looking for. Again, it's not the compromise of an income plan. It's not the compromise of the tax planning. It works with them. And what we found is that Sterling is really going to do we believe it's going to do a really nice job of kind of being a little bit of a yin to the yang to some of the other money managers that we work with. One example of that would be like Minneapolis Portfolio Management Group, who's a more of a value-based manager, and now we're bringing in more of a growth base. But they're both concentrated, both low turnovers, and both have got an institutional process that we know that we can rely on and such. So with that said, Tim Sargent, why don't we go ahead and start with Tim Covey's question. He's saying, hey, when do these boring days come back again? What's your best guess?
When do we get the good old days back, right? Certainly it looks like we're approaching that right now. And what I mean by that is we are certainly getting some great news when it comes to COVID vaccines and so on. And once we get the COVID vaccines, once we get them distributed out to the general public and so forth, at that point, we think there's the economy is going to turn back around. Certainly, a lot of the market recovery that we saw in the month of November was really based on the good news we saw with regard to the COVID vaccines. So we certainly believe that that's going to be something that happens in 21, depending on how quickly the vaccines and how widely distributed, probably looking more like the second half of 21. But the good news is we can actually see the light through the end of the tunnel, and it's good news. It's not necessarily a train coming at us.
So, one of the questions I'm getting a lot right now is about the election. Now that the election's behind us, what are your thoughts after the election? What are your thoughts about what to expect, I guess, more politically, and maybe stay away from the politics a little bit, but what do you kind of think is going to happen with the markets if you were to look in your crystal ball, knowing that any kind of forward type projections are probably unlikely to come exactly through? But what are your thoughts on where things are heading now that we've got that behind us?
Yeah, certainly. So that's a great question, and it's almost behind us, right? So at the end of the day, certainly the presidential election looks as if it has been decided. We're in the midst, I guess, of a little bit of some challenges that are going on, some lawsuits. We'll see how that certainly goes. But right now, all eyes are on the state of Georgia. And the reason for that is we do have Senate runoff. And really what Wall Street likes the most is when we have split government. What I mean by split government is certainly when we have a president of one party and then we have a Congress of a different party. And if you don't have a full Congress of a different party, at least you would have the Senate and then Congress being split, different parties. If it goes the way that I think the polling's going right now, what would end up happening is we would have a Democrat Congress, a Republican Senate, and then we would have a Democrat president. Certainly, we think that would probably be a good thing, certainly because we would have split government. Neither side would get everything they want, and that's kind of how Washington, D.C. was decided, or was created, was to have a little bit of gridlock there so nothing happens quickly. With that being the case, we think that certainly some of the things to take a look at that could be a positive would be spending. Certainly, Wall Street has never seen a relief package or a spending bill that Wall Street did not like. So certainly there would be some maybe medium or long-term ramifications from that type of spending. But in the short term, that would certainly be something that would be a positive. If we did have a split government, it would be a little more challenging to govern the way that that Biden ran on, which would be repealing some of the tax cuts. So that would be a little bit of a positive as well. And then certainly we think there's going to be some infrastructure spending and so forth. That's something that I guess we were all expecting to see under the previous administration. Certainly it should be something that we're seeing in the next administration as well. So certainly there's going to be the talking heads and the political people kind of gnashing their teeth and frustrated because this happened or this didn't happen. But at the end of the day, the split government happening, we'll find out January 5th. We think that should be a very strong positive for the market and for the economy on a move forward basis.
So Catherine is asking us here, her question is, when's going to be the next time to buy low again? And I guess follow up on that is, are we already low right now? So where do we think we're at with the market cycle where it's at today?
That's a great question. And I'm going to have to say a little bit of it depends. I don't know. And my crystal ball is a little bit foggy, right? Certainly, if I were able to tell you precisely when the markets were going to be low and high and so forth, I might be on some sort of a desert island with my beautiful bride, as opposed to having this wonderful conversation with you all. But at the end of the day, certainly we think that the market might had a significant run in November. We do like the fundamentals of where the economy is right now. If you kind of take a look at leading indicators, if you take a look at housing, jobs, unemployment, and there's something called ISM, which used to be PMI, which is Purchasing Managers Index. Anything above 50 is growth. If you take a look at manufacturing and non-manufacturing, SMI, they are both squarely above 50. One is 56.6, the other is 58 and change. I might miss it by a basis point or two, but regardless, both our manufacturing and non-manufacturing leading indicators are very strong right now. So we do anticipate the market being higher in 21 than it is right now. We're going to see some volatility, but Joe, I'm going to have to, that's my best tap dancing I can do. The answer is I truly don't know, but we are optimistic for a higher 21 than we have right now.
Well, and with my 25, 26 years experience, what I find is that, it's really more time in the market than trying to time the market. Unfortunately, we see it over and over again, especially when we start to see a little volatility. A lot of times we are tempted to sell out or raise cash, and then we find out after the fact that we missed the opportunity because we have to be right twice if we sell. Being able to buy in, a lot of times we do a lot of dollar cost averaging. Catherine, I'm sure you're familiar with how we do that. We add a little bit at a time so that we aren't necessarily going all in at any one time. And it's really part of an overall financial planning strategy, and not necessarily trying to predict the short-term highs and lows. Anyways, with that said, if you would like more information on Sterling Capital and how they may fit in with your portfolio, what I would recommend we do is go ahead and schedule some time. Let's visit and kind of review currently where you're at, and we can share with you how they would fit in to an overall comprehensive strategy. I am going to warn you now. I'd rather you call us right here, the 952-460-3260. We are awfully tight. It happens every December. We try to get as many families in throughout the end of the year. But if you call, and this is something that we can consider maybe waiting until January, just with all the different things that have to happen between now and the end of the month, we are really trying to start to look forward into January at this point. Now, with that said, if you've got anything urgent, something that has to be done before the end of the year, or if you really just need to visit with us, let's make sure we can get you as soon as possible. But if you have something, if this is a little less urgent, if you would like to come back and look at how the first quarter of next year, how to bring this into your planning, that might make some more sense. But the number is 952-460-3260. Just call that. We'll make sure that we have one of our advisors, somebody on the team here to talk to you. We can share with you some information on them. Sterling has done a fantastic job. We're awfully excited about the relationship. And Tim, if I could, maybe we'll have you back on here in about, let's say 3 months or so, end of the first quarter. Let's kind of see how things are going with you guys and kind of review what's new with Sterling Capital at that time. So I do appreciate the time, and I know we're running a little low here. Tim, any last remarks before we go ahead and end this week's Market Huddle?
I would just like to wrap up again by reiterating the fact that thank you. Joe, really appreciate the partnership. Everyone on the line really appreciate the time. And again, I am an Ohio State Buckeye fan, so I should say go Bucks. It is Michigan week. And if the game is played, certainly they will hang 100. Again, thank you all very much. Have a wonderful, wonderful day.
And with that said, I hope everybody has a great week, and we'll be back next Monday with another Market Huddle. And enjoy the rest of your day and have a great week.